Good morning and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, December 5th, getting closer and closer to a new year. Can hardly believe it, but we have got another jam-packed half hour to go over. Got a very interesting schedule today. Go through, of course, the market recap, earnings, upgrades, downgrades. We got the FAANG update. I want to go ahead and go through those FAANG stocks for you, let you know what's going on there. I'm going to talk a little bit about volatility. If you're a fan of watching the volatility index, which I am, it's probably my favorite sentiment indicator at this point. You do need to know that the volatility does change depending on the kind of market that you're in. So whereas maybe before we looked for the volatility to reach the mid-20s or up into the 30s even before we'd see a market bottom, when you get into more of a bull market advance within a secular bull market, that is normally not the case. So I don't think we're going to be looking for that type of volatility going forward. I'll talk a little bit more about that later in the show. And then we will finish off with three you must see. Those are three charts that I just think you want to take a look at before we go into a new day's action. Let's go ahead and jump into our schedule. I want to continue to mention January 4th. It's now only a month away. Saturday, January 4th, Market Vision 2020. Keynote speaker is going to be John Murphy. Got a lot of my friends and colleagues here at StockCharts.com that will be joining me to give their outlooks on 2020. I think it's going to be a wonderful day, probably the best online financial conference of the year, at least in my biased opinion. Should be a lot of fun, though. And I want to show you, if you read there on your screen, if you go to the Market Vision 2020 tab, at the top at earningsbeats.com. All you do, click on that. I'll show you exactly the page it's going to bring you to. You will come into this page, and all you have to do is put your name and email in. Now, that doesn't register you for the event. It registers you for our newsletter. And the newsletter is really important because we have a lot of mini-series. For instance, tomorrow, Arthur Hill is going to be doing a mini-series at earningsbeats.com, one of the mini events that we have leading up to Market Vision 2020. It's an opportunity for you to listen in to Arthur's style, his strategy, some of the things he looks at in the market. We're doing this for most of the speakers to give everyone a free look at how all of these different technicians approach the market, their different styles and strategies. I did one last Friday. Mary Ellen McGonigal did one a couple weeks ago. Again, tomorrow is Arthur. Really important. And the reason that you want to sign up for this is because in order to get the room instructions to come in, we send it out to newsletter subscribers. So just signing in is free. All you do is put your name, email address, click submit, and then you will get information. The other thing is Arthur's going to be giving away to one lucky attendee a 6-month trial to his new service. 6 months for free. It's a couple $100, $200-300 value. Last Friday, I gave away 4 quarterly memberships. The week before that, Mary Ellen was giving away memberships. So it's not just about learning and coming in for a free webinar, but it's also an opportunity to win some pretty nice giveaways. Anyhow, that is coming up on January 4th, so you want to mark your calendar for that. And let's jump into what happened to the market yesterday. Nice recovery. Dow Jones Industrial Average, as you can see, up 147 points. The S&P up 20, NASDAQ 46, and the S&P 600 Small Cap Index rose almost 8 points. And that was the leader, by the way, on a relative basis. Starting to see that a little bit more and more. I'm a fan of the small caps. I'd love to see us come back up here and break above that 1,000 level again. The 10-year Treasury yield up 3 basis points today. We'll talk a little bit about an economic report that was out just about 30 minutes ago. As far as sectors go yesterday, energy led, up 1.5%. Nice pop in crude oil. Crude oil has been moving back up. It's near $59 a barrel. And energy moving up yesterday as a result. Financials, one of the leaders in the market, moving higher. Still got some negative divergences that we have to deal with there. You can see the lower PPO with higher price. Might just be looking at sideways consolidation here. I think a big factor in what happens to the financials in the near term is whether we continue to rise in the 10-year Treasury yield. So keep an eye on that. Healthcare moving back up. This has arguably been the best group off of that October bottom. Seasonally, healthcare, I talked about this on Tuesday with my seasonality segment. Healthcare loves the next couple of months. December, January, February all tend to be months of outperformance for healthcare relative to the S&P 500. That's not a guarantee. That's history. So we'll see whether or not that holds up again. But technically, I think you probably would agree XLV looking pretty strong here as we head into the last month of 2019. Specialty finance, all of a sudden regaining some of its strength that it saw earlier in 2019. It has broken out on an absolute basis, starting to show a little bit better relative strength. So this is a group to continue to watch. Nice day yesterday, rising over 1%. And then pharmaceuticals breaking out in the near term. Got some overhead resistance. Going to talk about that in just a minute. But pharma's up over 1% yesterday, joining in with many of the other healthcare industry groups, pushing to a new high above that 590 level. All right, 10-year Treasury yield. Let's get an update. Make sure we get the very latest here. 1.81%, up a little more than 3 basis points. Initial jobless claims came out a half hour ago. Recently, we've seen some high readings. Not this week. 203,000 this week versus 218,000 expected. So it came in much below expectations. And that 203,000 number, that was a 7-month low. So things starting to heat up maybe a little bit there. And that could be one of the reasons why we have seen the yield move up today. I do want to say this, and that is that the 10-year Treasury yield had been declining under that 20-week moving average. We saw a change there at the beginning of November, went back down, and now it's coming back up higher. This is kind of an important deal because if we do get back up above 195 and we can stay above this rising 20-week moving average, it seems to be flattening now, but it will turn higher if we go back up through 195. That would lead to something maybe like we saw at the end of 2017 into early 2018, and that coincided with a huge market rally. So you want to be watching this. A move up on that 10-year Treasury yield back above 195, I think would be very, very encouraging. All right, taking a look at some of the action a little bit more in more detail from yesterday. You can see this is the energy ETF, the XLE. Here was the bounce up. Recently, the last 6-7 weeks, 58 has been the support area. We bounced right off of that yesterday, gained 1.5%. And with crude oil up a little bit more today, I think we're going to see a challenge of that 20-day moving average. Although, to be quite honest, these moving averages on a sideways consolidating chart mean very little. Moving averages are great when you're trending. When you're not trending, they just send you all kinds of wrong signals. You move up above, you come back down below, you move above, come back down below. It just goes on and on. It's not until you start to break out. Like if we move up to 61, 62, come back, hold that rising 20-day moving average and break out again, that is more along the lines of a trending market like we saw back here at the beginning of 2019. See how we hold these 20-day moving average tests, keep rising. That really hasn't been the case the last several months. That's what we want to look for with the XLE. One problem that the XLE could have is that it's probably its best group, pipelines, closed the day before yesterday below 640. And if you look back, that's one of the lowest levels, whether it is the lowest level since back in the early part of 2019. So pipelines, which had been actually a pretty strong performing area of energy, is actually breaking down. And you can see these failures at the declining 20-day moving average. So that's telling us we've got a group that's trending lower. So within energy right now, I'd be a little more careful with the pipelines until we can get above that 650 area. XLF, the financials, here was your breakout, double top, right at about that 28.5 area, kept going higher and really didn't pull back much until we printed this negative divergence, lower PPO, higher price, came down below the 20. I think maybe we're going to consolidate here for a while. I'd love to see a breakout on the XLF, a breakout on the 10-year Treasury yield. But just looking at it at this point, I would say the odds are greater that we're going to see consolidation. The specialty finance group within financials, here was that slight breakout above the September high. You can see the great performance in the specialty finance area throughout 2019 up until the high in September. Now, you can maybe make an argument inverse head and shoulder. Moving up, left shoulder, neckline, head, right side of the neckline, right shoulder on the 20-day moving average, and then a breakout. That would measure from probably about 313 down to about 278. So that's 35 points. That's going to take us roughly up to about 350 on the measurement. So SP, the specialty finance, looking pretty good. How about investment services also within the financials? This was a group, you know, we just saw specialty finance rising a lot throughout 2019. The investment services have been going mostly sideways. So this breakout's really significant, and this is a group that stands to benefit from rising treasury yields. So if the treasury yields continue to push higher and we do get that breakout, look for leadership from this group, investment services. Next up, insurance brokers. Another financial group, sideways consolidating, making a breakout here, pulling back, so far holding that rising 20-day moving average. I think the insurance brokers look pretty good. Getting over to that healthcare space, the XLV, sideways consolidation for quite a while. Not anymore. Huge month in November to break out here. And again, I'm going to show you, just in case you were not here on Tuesday for the seasonality, if we pull up the XLV and just look back over the last 20 years, you can see November and December tend to be very strong months. January pretty strong as well. And when we compare the XLV to the S&P 500 historically, you're going to see that we are in a pretty good sweet spot for healthcare. Outperformance in November, outperformance in December, outperformance in January. January is a very strong month for healthcare. So looks like we've still got a lot of historical tendencies supporting the XLV continuing to rise. So not only does it look good technically, but it is in a historical sweet spot. Let's go back to the pharmas. Let's look at this chart. Now, on that little short chart that I showed you at the beginning of the show, it looked like it was just breaking out. But when you look back now at a 1 year, and I'm going to stretch it out to a couple years here, it's a little bit of a different story. I think the group's going to break out because of rising tide lifts all boats. I think this one's going to break out. I don't expect it to be a relative leader, but I do expect it to be moving higher. 600, a little above that 600 level is going to be important. Also, the July high, just about 596 or so. So we're getting close to a key area of resistance. I would expect we'll probably back off of that a little bit before we just go flying through it. All right, let's move on. Let's move on to earnings. There were a ton of earnings out the last couple of days, not like the middle of earnings season, but I think I had looked and there were probably about 70 or 75 companies reporting between yesterday and today, which is pretty big deal now that we're so far removed from the heat of earnings season. But let's go over a couple of these. Synopsys, SNPS, the stock is down about 2.75% pre-market. So it's going to be challenging these lows, getting closer to these lows that we saw back in October. We're going to want to watch that to make sure it holds. You've also got this gap support that comes in around that level as well. I'm going to say about 132. Watch that. They did beat their bottom line, 115 versus 113. Let's take a look at a couple others that had big reactions or are having big reactions. Verint Systems, VRNT, it's a software company, had been downtrending, really did not look good at all. Well, this could be a character change kind of an event. They blew out their earnings, 94 cents versus 84. Stock is up 15% pre-market action. So we're talking about that would be about $7. It's going to take us up around 55. Still not necessarily breaking out above these prior highs, but you can see this is a company that has a history of big moves after earnings reports, and this is not going to be any exception for sure. So VRNT looks good, but let's see how it trades after the open. How about ESTC? This is Elastic. Elastic is down 15.64%. They came in with better than expected earnings, 22 cent loss versus a 32-cent loss expected. But the stock down more than 15%. It's going to be down here above or below these recent lows. Probably not going to be looking very good into the open. A huge loser yesterday was HOME. Poor guidance, and I'll say this. I say this all the time. There's never just one cockroach in the kitchen. Look at this. Look at these gap downs. First, a huge one back in March, came back basically to fill the gap. Another huge one in June. This time we didn't come back up and fill the top of the gap. all we did is basically fill to the bottom of the gap. So we had this huge sell-off, 40 million shares, and that, I would say, tends to be the area, major area of resistance. When you have that many sellers coming in between 10 and 1050, whatever that is, chances are when you get back to that level, you're going to see some more sellers. And that's exactly what happened here. This stock is now down 43% pre-market. Big drop to the downside. I didn't see exactly, I think it's $4 and change. That's going to take it back down close to this August low. And, I showed you the VRNT chart where it's gapping up. You got a character change. But many times these stocks that underperform like this, just, the hits keep on coming. And they're going to take another big hit at the open today. All right, let's move on. Upgrades and downgrades. I'm going to start here with Google. Google getting an upgrade. I like this upgrade. I like Google. I think this is one of the better FAANG stocks. We're going to talk about the FAANG stocks in just a minute, so I won't spend a whole lot of time here. But I think the volume trends look pretty good. We just got a breakout in internet stocks, and Google's been leading since that relative bottom in July. So I agree with the upgrade. I like Google. Facebook. We got another FAANG stock. So don't want to spend too much time. But once again, in the internet space, this one's been a little more flat on a relative basis to the internet stock. So it's being upgraded. I'm not going to say I disagree with it, but at the same time, I'm not a huge fan, just given the fact I think there are others out there better. Google's one of the a stock that I have in my model portfolio over at Earnings Beats is EverQuote, EVER. That stock's been on absolute fire. That is in the internet space and has been a much better performer. So I think Facebook's trending higher. It's not a bad stock. Looks okay to me. I think it goes higher. I think it eventually breaks out here. But is it going to be the leader in the space? I don't think so. Not yet. I don't see anything pointing me to that conclusion at this point. Another upgrade, Nike NKE. Off of an uptrend, looks like maybe a little bit of a cup forming here. I think the stock's going to head back up to that 96, 96.5 area. This one did move back down, go below price support temporarily. It looked like volume was picking up, but it has rebounded pretty nicely. So it looks like the overall uptrend remains in play here. I'm okay with that upgrade. One more upgrade is Yeti, YETI. This one's just sideways consolidating while the recreational products group breaks out. So its peers are breaking out, and this one's not. So it's a head scratcher. It's not breaking down, but it's not one of the leaders. I'd keep it on my radar, but it's not one that I would own here. So I don't know about that upgrade. Downgrades, of course, Home was downgraded. Stock's down 43%. Nice timing there. Etsy, ETSY, being downgraded. The stock took a big hit on heavy volume at the end of October with its earnings. Came back up, tested the 20-day, bearish engulfing candle, now a downgrade. I tend to agree with that downgrade. Etsy is not looking very good. It is at a 52-week low relative to its peer group. Not a good look. All right, let's move on. A FAANG update. Let's go ahead and take a look at some of these stocks I was just mentioning. I'll go through Facebook and Google pretty quickly since I've already taken a look there. I just think the big thing here with Facebook is we got to get through 207, 208. It's a hold in my view. It's not a strong buy at this point. It's just a hold. I think if I was in it, I'm okay holding it. It's just going along for the ride relative to its peers. Its peers are trying to make the breakout, though. So Facebook's a good, solid trade, I think. It's not one that jumps off the chart at me. Let's take a look at Apple. Apple, I've got concerns with. I still love Apple. This is one I've talked about for several months. I think the stock has been a leader, continues to be a relative leader in the computer hardware space. But just keep in mind that we do have a negative divergence. And if I pull up the seasonality on Apple, December is one of its worst months. Last 20 years, it averages going down 2%, 1.9%, which ties September for the worst month of the year. So this is a month where Apple tends to struggle a little bit. And if we go in and look at the divergence, you can see on the last attempt at the price high, look at the PPO coming down. I just think the stock needs to consolidate. I still love it. Longer term, I certainly would hold on to it. I'm just talking about short term. You know, over the next few weeks, are there better places to have your money? I think probably there is. Apple did, I think someone did raise their price target, might have been Citigroup. So I wouldn't be surprised to see the stock have another push to the upside. I just think it's going to struggle with 270 with that PPO looking the way it is. If you don't get big volume and a breakout above 270, I would be a seller in the upper 260s and see if I can get a little bit cheaper. Amazon. Amazon, not a fan, just not a fan. Longer term, yeah, great company. I'm not saying it's not a great company. I'm just saying I don't want my money in it right now. Look at the relative strength versus broadline retailers. Been going straight down for months. Let me show you another company in that same space. Target. Look at what Target's doing. Would you rather own this or Amazon? And I'm not asking you which is your favorite store, which one you shop at more often. I'm saying, looking at the chart, which one would you rather own? Target is a leader in the broadline retail space right now. Amazon is a major laggard. Not a fan of Amazon. Now, that may change. It might change in a month. It might change in a few weeks. I mean, that's what we do in technical analysis. We're watching the price action. But right now, no, don't want it. Netflix. Netflix, I tell you, watch this 20-day moving average. Short term, maybe it's starting to strengthen on a relative basis, but in a good market where we're recently broke out to all-time highs, I don't want to own Netflix when it's down near a 52-week relative low to the internet space and it loses its 20-day moving average. So that is where I would be watching very closely. And then finally, Google. Already talked about this. I love the relative strength. You can see this one bottomed all the way back in July. And with this earnings report, we had that character change really move to the upside. We did come back and fill the gap, but a lot of it was the fact that internet stocks in general were coming down. Google on a relative basis has continued to trend higher. So if you like internet stocks, Google is one of those that I would be favoring. All right, moving on to volatility. And I'm going to show you a couple charts on volatility that I think are important. This is a one-year chart on volatility. I wanted to just kind of point out how you sometimes can spot bottoms form in the market. When you are downtrending in the VIX, any kind of news comes out, the market pulls back, you get a little spike in the VIX. But notice a lot of times at the top, you have this big move up, hollow candle, and at the top, a lot of times you get it followed by a big red candle after you move to a new high. So in other words, the fear was even higher, but then you got a big reversal. Well, that a lot of times will mark a reversal in the stock market as well, especially, like I said, when you're downtrending in the VIX. So here we're downtrending, big pop, reversal, back down. This is where we bottomed. We did not go back down below that low. Here, 5 days up on the VIX, had a new high, reversed. That marked a bottom, moved back up to the upside, never saw another low below that, at least not for a while. Here, 4 or 5 days for the most part moving up. There's a reversal, another bottom marked. We move higher. Big move to the upside. There's your big reversal. This time, we did go down briefly on the VIX, came back up one more time. We did set a new low here and then started moving lower again. But notice something when we moved lower. And I think this is really important in the market. Here in late May, the headlines were horrible. Everybody was panicking. The S&P 500 had dropped from 2950 to 2750 in 30 days, 4 weeks. That's a pretty big drop. But notice the fear level at this low was not even close to the fear level back earlier in the month. So the market wasn't that nervous. I mean, we were breaking down, but the VIX is telling me not to be overly concerned. And of course, we did rally back. Now, on these next lows, because we did have this new low on the S&P 500 with lower VIX readings, check out August when we moved down. You see these 3 equal lows? Look at what the VIX did on all 3 of those equal lows, kept going down. So the fear level is declining, even though price action keeps going down to that new low. Here we did the same thing. Came back down to equal lows, lower VIX, and then the VIX starts to break back down again. What I'm looking at here is a move up on the S&P 500, fear growing, we get a pullback. Now, one thing to keep in mind is that the S&P 500, I'm going to come back to this. Let me just go over here and show you this chart. The S&P 500 right now has a negative divergence. Higher price. You see this rolling over here? to me, this looks a little bit like what we saw back in April and May. The big difference being that I think we've now broken out and confirmed a secular bull market, whereas we were still really trying to consolidate back then. Still, the momentum is weakening here on the S&P 500. Now, I don't think we're going to see this kind of move lower in the S&P 500. I wouldn't be shocked, though, if we see one more move lower. And the reason being, I want to show you this other chart on the VIX. Now, this is the VIX, the 5 and 10-day EMA featured. So you don't see the individual action. And the way you can set that up at StockCharts is show an invisible chart and then have your overlays, the 5 and 10-day. So that's how I get this chart. But on the bottom is the S&P 500, and I'm just kind of showing you what might happen here. And down at the bottom, I've given you the historical performance on the S&P 500 since 1950. From the 7th of December through the 15th, today's the 5th, next week is when we're talking about. 7th to the 15th, you can see minus 12.78% annualized return since 1950 on those days. The 11th to the 15th is where you see most of that weakness. Second half of the month, we tend to explode to the upside. The market likes the holidays. So everybody gets in a festive spirit. You're looking forward to next year. Everything's, going to be awesome, and the market tends to take off. So what I'm thinking is, with futures higher today, maybe we get a little rally to maybe a double top, and then one more move down, which would kind of coincide with the historical tendency. And then from that point, we rally back to new highs heading into 2020. It's just a guess, okay? Don't get carried away. This is just a guess. You kind of putting together what the market looks like technically and some of these historical trends. All right, let's move on and close out the show with 3 you must see. I'm going to show you 3 stocks that are breaking out that I just think are worth noting. First one is Cardlytics, CDLX, and I'll show you this on a relative chart. Here is an internet stock, okay? We were talking about leaders. I talked about EverQuote, EVER. Well, CDLX is another one. Look at the volume trends coming in. Look at this stock taking off to the upside. This is in one of my portfolios over at Earnings Beats, and you can see why. I mean, it's just a great performer. Relative strength is there. The group, internet breaking out, volume trends are solid. That's definitely a chart you want to be aware of. Next up, AMED. This is in the healthcare providers group. When I looked at the relative strength of the various groups over the last 3 months, I may have been doing this at my Trading Places show over at Earnings Beats. I can't remember if it was here on Tuesday or over there. But healthcare providers is one of the areas of the market that has been the strongest over the last few months. And you can see it right here. Well, AMED has broken out as a leader among this group. And so, I wouldn't go rushing in to chase a stock like this, but this is one that I certainly would have on my watch list, on my radar. And if you get a pullback back down close to that 20-day moving average, it's one absolutely to consider. And then my final one, going to stick with the healthcare area, biotech stock, Vertex Pharmaceuticals. It's one of my favorite stocks in the market, period. Another stock that I am favoring over at Earnings Beats. Look at the volume trends here, which are huge. I think that's just reeking of accumulation. Institutions accumulating the stock. Here's the big breakout. It's a large cap biotech. If biotech leads, look at the leadership in Vertex relative to the biotechs. So you've got one of the best performing stocks in a very, very solid group. And when we look at it on a weekly chart, one last chart I'll show you and then we'll exit. Sideways consolidation for 2 years before this breakout. I think this is big. All right. Want to thank everybody for joining me today. Everybody have a great day, and hopefully I will see you back here next Tuesday. Happy trading.